Our- There we go. Our session will be recorded, and we'll share that along with the slide deck with you after the conclusion of the webinar this morning. So please join me in welcoming our experts here from our Olson Thielen Tax Department. We are so excited to have them here with us on our Telecom Talks. We'll be hearing from Ryan Vetras, Tax Director and 990 Specialist, and Zach Dale, Tax Director, and Joe Mayer, a principal here at Olson Thielen, both of whom specialize specifically in advising clients in our telecommunications industry. So very glad to have them all with us here today. We'll start by learning a little bit more about the Form 990 compensation reporting. So I'll turn it over to you, Ryan.
Thanks. I'll share my screen here. Hopefully everyone is seeing what I'm seeing here. So if it looks good, I'll continue.
Looks good.
All right. Well, hello, everyone. My name is Ryan Vetras. I am a tax director here at Olson Thielen. I do head up our nonprofit tax area. And so this morning, I'm specifically going to be talking about the 990 tax return, specifically compensation, who and what to report. But I did want to start off by saying, I know not everyone on this call is currently in the 990 tax world. The 990 is the tax form that's specifically filed by tax exempt organizations with the IRS. But as a cooperative, always in the future, there's a chance that you could qualify as a 990. If that's the case, file this away for later use. If you're currently in the 990 world, 2024 filing season's coming up here. So we're already in the midst of it. So hopefully this will be some relevant information for you as we move into the 2024 filings. Okay. Let's see if I can move to the next slide here. There we go. So the topics I'm going to cover today, just 990 compensation overview. What are we doing as far as compensation on a 990? Who is specifically going to be reported? We don't want to over-report or under-report. So definitely an area we want to focus on. The big topic, what is included in compensation and benefits? What's not included in compensation and benefits, and then I'll go through any questions too. And now I guess I should say too, if there's any specific questions that come up along the way, I will try to be monitoring the chat, but Val can certainly interrupt me too. Otherwise, I'll go through some questions at the end if there are any. Okay, kind of a 990 compensation overview. I started out by saying, this is focused on 990s. The 990 tax return, as most of you probably are aware, is a public document, meaning that there are several websites along with the IRS website itself where you can actually look up a copy of your organization's 990 tax return that's filed. And the public can look that up and they can review those as well. So the reason why we want to make sure compensation is reported correctly is because that is a public document that people can view. So just a kind of a definition here, compensation is required to be reported on Form 990 to ensure transparency, compliance with the IRS regulations, and to provide the public and the IRS with information to evaluate the organization's operations and governance. That's pretty wordy, but just basically saying that the 990 is a place to report for transparency purposes with the IRS. The importance of transparency is that public trust and accountability. The public would like to know how their donor funds are being used in a charity purpose, membership dues, an association purpose, or just member revenues in a co-op purpose here to make sure that they're being used correctly. So the transparency is crucial for those people to know that the mission is being fulfilled. It also helps prevent abuse. I know there's a lot of charities, I should say there's not a lot. There are a few charities out there that are bad actors that are using donor public funds for personal gain. So by having this reporting compensation requirement, it helps to ensure that there's not abuse within those types of areas. And now I will say too that this is a public forum. The public could look up the salary information here too. They may not understand what's being reported. So that's another important area where you're going to have to, if you do get questions from the public on that, just to educate them and and to show them where this compensation is being reported, how it's being reported, and if it's the correct amount that's being reported to. Lastly here, compliance with the IRS regulations. There's specific code sections for the IRS that say, if you're a 990 tax return, you need to file an informational return each year. And included on that form, they have specific instructions for guidelines for reporting compensation. And that's what we're going to go through here this morning too, is just kind of what exactly needs to be reported. Okay, before I started on what, let's go through who is included on the compensation. I've oftentimes looked at 990 returns and I see that there's every single person that's compensated by the organization is listed. That's not always necessarily needed. So who we report is important. Starting at the top here, current officers, directors, and trustees. Any amount that they're paid, they're going to be reported on the 990. What is an officer? For the IRS guidelines on this, the officer is going to be your highest management official and going to be your highest financial management official. So that's going to be your CEO level and CFO level officers. Whether or not they go by that title or not, those are going to be two officers that are specifically going to be reported here. You also want to look to the IRS says that any other officer that would qualify as part of your bylaws would also want to be reported to. So if you have an operating officer that may still be in kind of under that top management official, but still have control, that type of control, they may also be reported here as an officer. Directors are going to be your board members, your board of directors. And if they get paid any sort of compensation as part of being on that board, it's going to be reported here as well, no matter the amount there. Trustees kind of fall into that same category. Lastly here, key employees are always reported. There's specific tests for key employees. I'll get into that here in the next slide, but that they would always be reported here as well. Okay, and then after you have those reporting, you'll just take the next 5 highest paid non-key, non-officer employees that have compensation over $100,000. That's kind of the threshold it's been for a long time. So really just if you have a number of those employees, you just know that there's always going to be at least 5 of those over $100,000 that are non-officer and non-key employees. But outside of that, any other ones that are over that $100,000 threshold, we wouldn't need to report, just the top 5. And now I have former categories here listed: former officers, former highest paid, former directors. Pretty narrow area here. Really, that's if you had an officer that was maybe getting a severance package or something like that, that there's reportable compensation when they're not actually currently an employee. That's where they would be reported, but pretty narrow section here, so I won't go over that in too much detail. Okay, I do want to cover a key employee. They're not an officer, they're not a director, but maybe they're a key employee. To be a key employee, there's 3 specific tests that you need to pass to be reported here. $150,000 test, pretty clear. You're going to be looking at the W-2 is at $150,000 or over, then they would be a key employee for that definition. Responsibility. The employee had shared organization-wide control or influence, just like an officer. They may not qualify as an officer per the bylaws, but they do have somewhat organization-wide control or influence. Or that employee managed or had authority over at least 10% of the organization's activities. So if there was a division that had a leader in that division that, again, had over $150,000, they would be considered a key employee. And then the last test here, we're only going to report at least the top 20. So if you really truly had 20 of these key employees, that would be the amount that you would report there. We don't see a lot of key employee definition or reporting by this definition, at least in our level of organizations. Okay, so moving on from who, now we're going to go into what. This is a big area that we want to focus on just because we want to make sure that we're reporting the correct compensation. So there's kind of 3 different areas: reportable compensation from the organization itself, reportable compensation from related organizations, and other compensation from the organization and related organizations. So that's going to be kind of your other benefits type of reporting. I want to specifically note here related organizations. Sometimes we think, well, if the organization maybe sets up a subsidiary, that covers maybe the payroll compensation stuff too, that still would get roped into the 990 as a related organization. So it still is going to need to be reported, even though the possibility that the organization isn't directly paying those individuals. So I just want to put that up here as well. Okay, this might be kind of small to see, but I included a kind of a snapshot of what the actual 990 form looks like in this area. And so let's see here. So we can kind of start here. It goes through kind of a definition, specifically on the 990 itself, of who should be reported up at the top. But focusing on down here, this is where the public is going to see name and title, and then they're going to see how that person is identified, kind of those categories that I went through a minute ago. And then see, we're going to focus on three areas here going forward, really specifically two, but reportable compensation from the organization, and then the other benefits and compensation that are reported from the organization. So just kind of a snapshot to see what what the public is looking at when they're seeing this. Okay. Specifically now, what is included in compensation and benefits? Really what the IRS is looking for here is going to be what is taxable income to that individual, and that's really what should be reported here. To start off in that first column that I showed you, um, really we're going to be focusing on W-2 box 5. Form W-2 box 5 is going to have all the, if it's prepared correctly, it's going to have all the taxable compensation that the IRS is looking for in this area. Now, there are some other areas that I'll get into that may not be included there, but generally when you're starting with what is reported for compensation, it's going to be W-2 box 5. This is going to be including, some of your non-qualified deferred compensation and 401k and 401(b) deferrals by the employee. So that's why we start with that box 5 of W-2. For the non-employee compensation, that's going to be your board of directors. If they're getting any sort of fees as being part of the board, they're going to be issued a Form 1099 NEC, non-employee compensation. So you would use that number from that form as what is reported for those board members or any other non-employee officers and that type of thing. Other taxable compensation, so I'll get into that here kind of in the next slide. Like I mentioned, if it's correctly prepared, the W-2 that each individual receives, box 5, is going to really capture most of those taxable items that need to be reported. There's some pretty narrow areas where not many people on this call are going to be dealing with housing allowances, but if you had a clergy housing allowance, you're not going to find that on the W-2 box 1 or box 5. But it is considered taxable compensation that would need to be roped in here. So there's a couple of those areas. They're not large numbers necessarily, but you want to look for those as well if they're not captured fully within the W-2. And I want to circle back to here too, the IRS. I mentioned W-2 box 5 is because generally that's going to be the area that's going to include all the taxable income. However, there are certain instances when box 1 is actually higher. And in those cases, the IRS just says, report the higher of the two. So if box 1 for some reason is higher, then we're going to go ahead and report that. Okay, here's a whole listing of that other taxable benefits that I've talked about. Just some of these areas that most of the time these are included in the W-2, so you're not going to have to specifically note them, but I note the housing allowance in here too. There's just some other areas where they may not always get captured or even correctly captured on the W-2, so you want to make sure you provide those as well. Okay, so then moving on to kind of not necessarily the compensation column, but more that other benefits and other compensation, that last column on that page. This is going to be more where we're reporting the employer contributions to retirement plans. I should mention reportable contributions to qualified retirement plans. So that's going to be your employer match, profit sharing, and whatnot that goes into that plan. Other more specific areas here, deferrals by employees under specific 457B plans. Those are going to be your deferred compensation plans. Kind of gets a little bit hairy here depending on substantially vested and not. And if there are those areas that you see that, you're going to have to kind of go through a facts and circumstances kind of thing each year to determine whether those are reported. And we can help you with that too as we're going through the 990, preparing that. Stock options, when granted, probably pretty narrow area here. But then health benefit premiums paid by employer. We all know that health premiums are going up. This is, can be a significant area. So any of those premiums that are being paid by the organization for the employee, that would be reported here as other compensation and benefits. Okay, and when in doubt, I didn't cover every specific area, obviously. Oftentimes it's hard for me to refer someone to look at the IRS instructions on a form because they're very wordy and hard to understand sometimes. But in this area, the IRS actually has a pretty good set of instructions on compensation and what is included. I've included a link here on the slides if you want to look at it afterwards. I'm actually going to pull up I have this open. So hopefully everyone can see that as kind of a reference, but there's actually 2.5 pages within the IRS instructions of pretty much every specific type of compensation that you can think of. And if it's on this list, it's going to be reported. And if it's not on this list, you don't have to report it. But I wouldn't focus necessarily, if you are going to look at this, I wouldn't focus necessarily on all these columns. But basically, if you have identified here that you've got this type of compensation and there's an X by it, it's going to be reported somewhere. So if you do notice that, that's something you'd want to note with your tax preparer that say, I found this, we've got this type of compensation, provide that amount. And then what I would do is go from here and determine where exactly on the 990 it's reported. But really, this is a good list to kind of go through it. Again, it covers everything that would possibly be reported here, from the different types of non-taxable, taxable benefits that are out there, and the different types of retirement plans that can be covered as well. So a good tool to use if you're trying to figure out exactly what to report is to go to this IRS website. Okay, I kind of just threw a snapshot in here for your reference as well of what I just showed you there too. Okay, lastly, I'm going to talk about just really quickly what's not covered. These are just going to be your non-taxable fringe benefits that you provide to your employee. If it's not taxable to the employee, then it's really not going to be reported to the IRS. So fringe benefits, parking, meals provided by convenience of the employer, business use of company car, the business use, obviously. Personal use, that's a different story. Business use is going to be not reported. Expense reimbursements under an accountable plan. Again, those are all things that are not taxable to the employee, so then they would not be reported here as part of 990 compensation. Okay, and really that's all I had. It seems complicated, like a complicated area, but really if you refer to those instructions and kind of this presentation that I had, it should kind of get you through exactly what you need to report. I know obviously there's going to be some questions maybe on what, as far as retirement plans are concerned and what's reported there. Oftentimes you're just going to be reporting the deferrals each year, contributions by the employee and the employer. So that's going to be generally an area there that you're going to want to focus on. But otherwise, yeah, if there's any of those specific questions, I would say refer to that IRS list. They really do kind of walk you through everything. And then from there, if it still doesn't make sense, you reach out to your tax provider. And I've included my name here and email address, phone number. If you want to reach out to me, we can kind of go through some specific questions. Otherwise, if there's a general question or two that I can answer now, that would be fine. And I don't know if I see anything in the chat currently.
No, not seeing any open questions right now.
Okay. Certainly do reach out to me though, if there are any specific questions on this, or something you think maybe is a little more narrow than this presentation covers, I can certainly walk you through that.
Okay, thanks, Ryan.
All right. Well, yeah, if there's other questions, or if you think of something while Joe's presenting here, you can certainly reach out at the end and I can help you with that too. But I'm going to throw it over here to Joe. Just going to talk about some more co-op specific ideas.
Hello, everyone. My name is Joe Mayer. I'm tax principal here at Olson Thielen. And also Zach Deo, who's a tax director, will also be participating. So we're going to go, and it does say cooperative tax update. That's really, we will be focusing on some cooperative things, but also just regular telephone taxable things as well in this presentation. So going through it, we will go through a little bit on the cooperative tax area. Some of the things that we can do in there, dealing with capital credits. We also go over grant income, grants, and planning for those. Some changes in net operating losses and some other current year tax changes that are going to be coming up. This year is probably going to be a big year, considering the change in the president. Trump obviously is looking forward a new tax bill, and I think there are going to be some things that come through in the next legislation that are really going to affect telephone cooperatives, and telephone companies in general, hopefully for the good. We've seen recent tax proposals that have not come through, but they're all favorable for both grants and depreciation. So we are kind of looking forward to what's going to happen, and hopefully it's going to be something that we'll be able to use for planning going forward. So, you want to move forward, Zach? So we're going to start off with cooperatives. There are several types of cooperatives, and it's interesting, especially dealing with the IRS. The IRS doesn't really understand telephone electric cooperatives very well. They're more familiar with agricultural, just general co-ops, and there's a big difference between the two. Those agricultural co-ops are taxed under a completely different section of the Internal Revenue Code than telephone electric co-ops are. And part of that leads to confusion, especially with the IRS. I'm right now dealing with an IRS agent on an audit with a telephone company, and they don't get it. And we basically have to kind of teach them the differences between the two, because they do understand the agricultural general co-op type information, but they don't really understand the telephone. So the telephone is taxed. Telephone and electricity are taxed under 501c12 of the Internal Revenue Code, which I think most people recognize 501c3. It's the same section as charities. So the way the cooperatives work under 501c12, there's two different types. There's a taxable and there's an exempt. And the differentiator between the two is what we call the 85% test. So the 85% test basically determines how a telephone or electric files a tax return. And that can be either as a taxable entity or a tax exempt entity. So what you're looking at in the 85% test is basically member revenue versus non-member revenue. If your member revenue exceeds 85%, you're can be an exempt. If it's less than 85%, then you're a tax. So what we're looking at is through those things is the member, that'd be the operating revenues from services, any other types of member revenue. And then there's non-members. That could be CLEC that's not in the area. That could be investment income, or any other non-member type income that comes through. And then there's also a third type of income that is completely excluded from the test. And that would be grants, excess charges, ATM, RDOF revenues, and unrealized gains. So like I said, if the member revenue is greater than 85%, then the entity files 990. And if the member revenue is less than 85%, the entity files as taxable. The taxable entity thus is allowed a patronage deduction for the member services that it provides. Now, this isn't a static, it's an annual test, so co-ops can flip-flop, and they also can, it's possible for them to plan to be exempt or taxable as well. And there would be good reasons for that. Continue on. So talk a little bit about capital credits. So co-ops have capital credits that are part of their capital, and that's returned to the patrons. One thing that is available to co-ops is being able to pay out capital credits early. And that would be some sort of early redemption of those credits. And what that means is that you're going to be paying out their capital credits before the scheduled time that they are. And generally that we paid out at an amount less than was included in their capital credit at the time. So we call that at a discount. So discounts are basically are calculated using a rate. It may be the financing rate. A lot of times it might be a little bit more than that because the cooperative capital is really more of a risky type of capital because that is technically the last type of distribution that can be made in the liquidation of co-op. So it is more risky because there may be more debts that are being paid and you may not get as much back. So that's one thing to consider. Also, it's common for estates to be reached, and a lot of our co-ops do that already through discounting. So there's advantages to this. First of all, if you're paying out less than you need to, it's providing permanent capital to the co-op. It may help in finding patrons. I know a lot of times co-ops have a hard time because you're paying out patronage that was earned years ago and people have moved and you got to find those people. So maybe help in that area. It provides a member an opportunity to cash out soon, to get their money sooner, which may make participation in the co-op much more attractive. So those are kind of positives. There are, of course, disadvantages to that. It is kind of a drain on the co-op. So obviously, if you are paying out patronage early, that means you have cash to do that. If you don't have cash, you're probably not going to be doing that. So that can be an issue. Also, if you're doing a program, it does take some planning, and then you do need to basically having the patrons vote on how they want to do it. So it can be cumbersome, and so that it can be a little bit more difficult. This is one area where we can help as advisors, as we can help you plan and come up with a program. Next page, please. So discounting capital credits has been approved by the IRS, so it's not something that is some sort of scam or anything like that. They do approve of it as part of it. They believe that it's part of the cooperative principles. Now, the issues that come up with it, discounting, is that if you're a taxable co-op and you're discounting, that discount is taxable income. If you are an exempt co-op, it is not taxable because you are exempt. So Discounting is actually much better in a exempt area. So if you're passing the 85% test, that's truly a good spot to do that in. However, there can be co-ops that do not pass the 85% test that still can do that. But you got to consider the fact that that discount is taxable income. Also, for an exempt co-op, that discount can be treated as non-member revenue. Now, the IRS has kind of weighed both sides of this, and there's rulings going both ways. So in a conservative view, if you're looking at it, you'd want to look at it to see if the discounting would affect your taxable status as either an exempt co-op or a taxable co-op going through the 85% test. But even in an exempt co-op, if you are an exempt co-op, that discount is not taxable and it is not subject to UBIT. Next up, grant income. So this is kind of new. The Tax Cuts and Jobs Act of 2017 created this little problem, which taxes grants to all entities. And because the broadband area is funded a lot by grants, it becomes a problem for telephone and electric co-ops. So in these situations, it has been working out pretty well to use grant income to offset through depreciation expense. But depreciation is now decreasing. So bonus depreciation at the time that this became law was 100%, and it's decreased to last year, it was 60% in 2023, and this year in 2025, it's 40%. So that means you get to be able to take a one-time charge against the capital assets that are placed in service at 40%, get that as depreciation. The rest is taken over 15 years if it's fiber. So that's that's one of the issues that's coming up. The other issue is timing the grant with the project placed in service. In theory, the best way of doing it is getting the grant and placing the assets in service in the same year. That way you can offset that grant with that depreciation using the bonus depreciation. However, it doesn't always work that way. Sometimes grants are prepaid, sometimes grants come in afterwards. So there's a timing issue that needs to be dealt with too. And we can work with that too, as far as matching up those revenues and expenses in order to obtain the best tax answer. Obviously, if you're a tax exempt co-op, it's not a big deal, but if you're a taxable co-op or a telephone company, it is a bigger deal to make sure that you are matching up the planned in service versus the grant that you receive as income. There are some states that do allow a deduction for that grant, or they are not following federal law. Iowa, for one, does not tax the grants. And Iowa also allows bonus depreciation. So Iowa kind of gets a double dip where you're not taxed on income and you also get to depreciate the property. When prior to grants being taxable, generally the way it worked was grants were offset with the plant and service. So there really was no income, there was no deduction, and you didn't get any further depreciation going forward because of that. But the state of Iowa is very nice and allows that double dip. Talking about grants themselves, in 2023, there was a bill that was put before Congress, and that bill was to allow broadband grants to be exempt from the TCJA. Now that bill didn't pass, but it was a bipartisan bill. And so that's one of the things that's hopeful going forward with the new tax bill that's coming up. Since it's already been out there, hopefully it's something that gets put into the new tax bill, or maybe possibly some sort of small corporation limitation as well would be nice. Because I don't believe that when the TCGA came out and said grant income is taxable, it really meant to tax broadband grants for rural broadband. I think it was more intended for larger corporations that were looking to relocate and having cities and states pay for their new facilities. So hopefully in the next bill, there will be something that will be talking about grants as far as making them less taxed for telephone companies, electric, and just in the small business in general. Next.
Oh, clicked on the wrong screen. There we go.
Oh.
Ready to roll. Yeah, thanks, Joe. As mentioned before, my name is Zach Dio, director in the tax department here at Olson Thielen. Work a lot in the cooperative space and across our business entities. And to kind of close out our time here, I just wanted to kind of build off of what Joe was talking about with the grant income and just touch on some of the things that we're doing as we plan and consult with our clients to, again, try to match up that taxable income from the grant with some depreciation and other things to reduce that tax liability as much as possible. So I'll get into a little bit of specifics, and then at the very end, I'll wrap up just with a little discussion around the potential tax bill that we think is coming here in 2025. So again, working from the space kind of specifically focused on a taxable cooperative where we've got some grant income that's going to be included in income. And then how do we reduce that as much as possible? And currently, kind of the theme that we're going to see is that some of these tools that we have with some recent law changes, they aren't going to be quite as effective as they have in the past. And so we may see some of our clients having some tax cash to pay where they may not have had that for quite a while. So kind of the first level, we're going to have the project with the grant funds. We're going to have depreciation on that, as Joe talked about. And so as much as we can, we want to accelerate depreciation on that project to, again, offset and match the grant income. So really the two main tools we've got there, bonus depreciation that Joe talked about a little bit. Kind of the key thing here, when you think about bonus depreciation, is one, under current law, it is slowly being phased out. So if we have a project that goes in service for 2024, we'd be able to write off 60% of that cost right away, and then the remaining 40% over the life of the project. Really the thing to remember with bonus is this is going to be a little bit more of a hammer than a scalpel. So if I have assets placed in service, say I built out a fiber project, when I go through to do the tax return for the year, I can choose to take bonus on all of that fiber build out or none of it. I'm not able to kind of pick and choose. So occasionally we'll see situations where maybe the grant money came in but didn't fund the entire project. And so we'll have, maybe 3 million of grant income to offset, but the total cost of the project was 6 million. And so we can either, there's no kind of middle ground. It's either we can take everything and end up with a loss for the year, or we can take nothing and end up with some taxable income. So just something to consider there when we think about bonus depreciation. The other tool that we've got is Section 179 expensing, which, like bonus, is just a dollar for dollar reduction. This does allow for kind of more of that scalpel to kind of pick and choose and manipulate income a little bit more. The thing to remember with 179 that we run into is, one, we can't use it to create any sort of loss in a given tax year. And then two, there is a phase out that starts once you reach a certain threshold for property placed in service. So I've got a couple years here. There's a limit on how much you can expense as well. And again, that property limit. So for some of our larger clients, we see that they run into where they phased out their deduction because they've placed more in service than the property limit is. So the 179 may not always be available, in which case we could fall back to bonus if we need to. Yeah, just kind of the tool there to help match the income and the deductions. The other thing that we have, before I shift gears too far. So on the state side of things, we have to consider whether or not a specific state really conforms to those federal rules. And it's a little bit of a mixed bag. I put up here kind of the 5-state area of Minnesota and its neighbors. And just, won't read through the whole chart. Minnesota specifically, for bonus depreciation, they don't conform. So really any bonus depreciation you take on the federal return is going to be subject to an add back and then a subsequent subtraction over the following 5 years. And so really this is all just about the state's kind of controlling the timing of when you get to take the deduction. You're going to end up claiming the same amount of depreciation. It's just when do you get to take it. And there are a few states, as Joe mentioned, wonderful Iowa conforms. So there's no adjustments that you have to calculate there. So this is something that we're monitoring as we go through and are working on the compliance side of things with our clients, making sure that we're reporting that accurate depreciation in a given jurisdiction in a given year.
One more thought on the depreciation.
Yeah.
Also for the co-ops, as far as the taxable co-ops, looking at their patronage, that's also a planning issue too. Co-ops don't always want to allocate a super large amount. A lot of times they don't want to allocate nothing. So using depreciation to affect what their patronage allocation is too is very important as well. So,
yep, and that's something that we consult on pretty regularly, and we've seen more co-ops switching from maybe kind of a book method to following the tax depreciation rules. So the other thing that I wanted to touch on, as we're thinking about reducing tax liabilities caused by the grant income, for a lot of our clients, there's some accumulated net operating losses that we're able to dip in and use. The big thing here that we want to think about with this is it's really going to depend on when that loss was generated and how much taxable income we're able to offset. So for example, if I'm a taxable cooperative, I go through, I've got my income, my expenses, I come down to the bottom, I've got $100,000 of net income still sitting there potentially subject to tax. If I have $100,000 of net operating loss that was generated, again, that pre-2018, that's sitting there, I'm able to offset that taxable income fully, and I'd end up with a net zero for taxable income and no tax liability. Conversely, same $100,000 of taxable income sitting there. If I've got a loss that I generated in say 2022, I'm going to be limited to offsetting 80% of my taxable income. So in that case, I'd have a $20,000 kind of net income sitting there that I'm going to pay tax on at a flat 21%. So really, it's almost kind of establishing a little bit of a minimum tax on corporations. But that's just something to remember there. And again, another reason we may see companies that typically haven't had a tax liability in prior years potentially having one now. And then on the state side of things, they've also, or Minnesota specifically, has adjusted their rules. And so regardless of when the loss was generated, it can now only offset 70% of taxable income. So again, kind of sets a little bit of a minimum threshold, and again, may result in some liabilities is existing there. That's something that, we're well aware of these rules and trying to be very proactive with our clients to make sure that we can plan for any cash need that's maybe coming down the road. And then lastly, to close out our time here, I just wanted to touch on the potential for a 2025 tax bill that Joe had kind of mentioned previously. Just going through a little bit on why we may have a tax bill. So I think that one is a little bit interesting, and then also is a little bit instructive of what may end up in that bill, and then go through some things that may relate specifically to our telephone cooperative clients. Overall, this isn't, on its face, there isn't a lot of applicability, because really we're looking at a potential bill because under the Tax Cuts and Jobs Act that was passed back in 2017, they kind of had to play some budgetary games, and to make the math work, they made a large number of the individual tax provisions temporary, and we're kind of reaching that window of when they're going to expire. We think that there's a bill likely just because if all those provisions were allowed to just completely sunset, it would be a pretty dramatic shakeup. And with the administration coming into office here, that was kind of one of the signature pieces of the first Trump administration. So I don't think there's a lot of appetite to just let those expire. It would also be a bit of a tax increase on kind of the lower and middle class, which doesn't always play super well in the political sphere. So that's kind of the reasons that we're looking at a potential bill, just kind of going through the mechanics of how they're going to get there, because that I think is going to inform a little bit of what it ends up in the final bill. Really, if we kind of remember back to our Schoolhouse Rock days, we've got the Senate and House of Representatives. We need a simple majority vote in each. The bill makes it through that, goes to the president's desk, gets signed, bill becomes a law. So right now, for the next couple years, we're looking at slim Republican majorities in both the House and the Senate. So the House of Representatives, they would be fine to draft a bill to get it through. On the Senate, they have the lovely provision called the filibuster, where basically a senator, a group of senators can just kind of get up and talk and effectively kill a bill. So really the threshold there to beat the filibuster is 60 votes in the Senate. So that kind of becomes the magic number for cutting off debate and really the threshold that's needed to pass any sort of legislation. So again, looking at the numbers on the slide there, to reach that 60 votes, Republicans would need 7 Democrats to come across the aisle. And that's a hard ask in these kind of partisan times. So really that leaves what's called the budget reconciliation process for passing any sort of tax bill. And really the thing to remember there is that under those rules, any bill can't increase the deficit over a 10-year period. So that's kind of the reason why we saw with the Tax Cuts and Jobs Act, the sunsetting and kind of the budgetary games, that was their way to not increase the deficit. So I think ultimately, based on where Congress is set right now, I think we're probably looking at using this budget reconciliation process again for a tax bill. And so ultimately, I think why we care about that is that it means there's going to be a lot of negotiation and probably at this point early in the process, a lot of uncertainty about what's actually going to end up in the bill. And there's been a lot of things floated around during the campaigns. We've had also failed bills the last few years that have put out various ideas. And I think a lot of that's really going to get settled here in 2025. I've seen potentially a bill early in 25, a bill late in 25. But I think the consensus is we're going to see some sort of legislation, and then really dialing back into what's impactful for our co-op clients and what could potentially be in that final bill. As we talked about, one, bonus depreciation could be extended or potentially even expanded. For many, many years, we were at 100% expensing under that. Maybe we get back to that, or maybe, I think in some form or fashion, it probably doesn't completely go away like it's scheduled to right now. Another thing that has been talked about quite a lot that applies to our corporate clients, may have some co-op applicability, is research and development expensing. If you're kind of creating a novel process, potentially being able to go back to write those costs off of the year they're incurred rather than capitalizing and amortizing over 5 years. Another thing that would be really helpful for co-op clients, especially as we're kind of in this area of grant income coming in, some potential tax liabilities. There's been talk about reducing the corporate tax rate. So right now it's a 21% flat rate. There's been, all kinds of numbers floated. Probably the one that maybe has the most traction is dropping that down to a 16% rate. So just kind of something that we're monitoring in our day-to-day just to see where this is going to shake out. But really at the end of the day, just remembering that probably going to see a bill, but very up in the air what it's going to look like. And be something very interesting to follow the ins and outs and the negotiations. So that was the piece that Joe and I had. Again, looking at some changes there with the grant income being taxable, and then we do have some strategies to kind of limit the tax impact of that, but again, may not be as effective as they have under prior law. I don't see any questions coming through, at least in the Q&A. I don't know if there's anything in the chat, but
Yeah, I don't think so. I don't see any either. So,
okay. Well, yeah, as always, well, I scooped away from my, so we're going to distribute the slides and we have contact info for Joe and I. And so if there's anything that comes to your mind as you're going about your weekend tasks, feel free to reach out and we'll do our
as you're
best.
thinking about taxes all weekend.
Yeah.
Exactly.
I mean, hopefully you're not. Maybe Monday. Wait till Monday.
Okay, well, thank you, Joe, Zach, and Ryan. And thanks everyone for attending. Appreciate your time here this morning.
Thanks for having us.
Yep.
See ya. Bye.
Have a good rest of your Friday. Bye.